Well, good morning, everyone. Thank you to those of you that have taken time to be a part of this webinar this morning. This is Lindsay Kiesler, President and CEO of the Chamber of Catawba County. This is part 5 of our COVID-19 in Your Business webinar series. I want to thank our partners who have made this possible, the Catawba County EDC, Catawba Valley Community College Small Business Center, and the Small Business Technology and Development Center. They have all of those organizations and more have stood arm in arm with your chamber to assist businesses during this unprecedented time. I also want to thank our speaker today, David Smith, who you'll hear from in just a couple minutes, and Even Concepts for taking his time to put together this slide deck and this content, this extremely valuable content on how to utilize PPP, and also the important topic of getting your employees back to work and things that you need to know. I want to thank Lori Lala, who's with us here this morning with Broom Associates, for also helping put together this webinar. A couple housekeeping reminders. Just remember to keep your sound on mute throughout the call. And if you have any questions, I encourage you to go ahead and utilize that chat box anytime during David's presentation. If you have a question, just throw it in the chat, and we will, actually Nathan Hewitt, who's the Director of Existing Industry Services at the Catawba County Economic Development Corporation, is also here, who will facilitate Q&A with David after his remarks. So at any time, throw in that, utilize that chat feature, and we will get to your questions at the end of the presentation. I want to thank Nathan for providing technical assistance for this call to keep everything running smoothly. I appreciate his work on that. But that's it for me. Just another reminder before I introduce Lori, who's going to introduce David. We are here for you. You're not alone in this. It has been such a privilege to stand in the gap on behalf of business during this time. So I truly appreciate that. If you need your chamber or EDC, we are here to assist you. Please contact us directly. It is now my privilege to introduce Lori Lala, who serves on our chamber board of directors. I'm proud to work alongside of her. She also, in her day job, is the equity partner and health and benefits consultant with Broom Associates. Lori, I'm going to hand it over to you to introduce David.
Wonderful. Thank you, Lindsay, and thank you to the Catawba County Chamber staff and also the EDC for your efforts to help all businesses in our community. The Chamber is integral to our economic vitality and provides valuable resources for all size businesses, and we appreciate the hard work that's been demonstrated during this difficult time, and also the efforts put forth by the EDC. So thank you both. As a Chamber board member, I have seen firsthand the extra effort that's been put forth, and I want to just mention a couple things that the Chamber of Commerce has done for business owners. One is a series of informative webinars. This is, of course, as Lindsay said, number 5. And they also have a COVID-19 tab on their website with a list of resources and links that will take you directly to various government entities. So please utilize that resource there at the Chamber of Commerce website. And they've also created a Takeout Blitz Catawba initiative to support local restaurants. So we do want to remember to support our local restaurants during this time period. And I know also, Lindsay, that you're conducting a business impact and recovery survey where you would like as many people to participate in that as possible so that you can get the feedback needed to help determine how the Chamber can best continue to help meet the needs of business owners. So maybe we can put that link in the chat box, and then if you will, please participate in that survey. That would be very helpful. And now our focus, of course, is to move forward in a responsible yet expedited way and start to look toward recovery. So I thank you again for all of your efforts there, both Nathan and Lindsay. I am Lori Lala, as Lindsay mentioned. I'm with Broom Associates, a division of Even Concepts, and I have the privilege of working closely with employer clients regarding employee benefits. And I have had many conversations regarding the FFCRA, the CARES Act, and now the Paycheck Protection Program and Healthcare Enhancement Act, which has added an additional $321 billion into the payroll protection program. I've had many discussions recently with clients about how to handle employee benefits while employees are laid off or furloughed, issues regarding unemployment, and employer protocols that can be implemented to ensure safe and sanitary work conditions as employees are brought back into the workplace. I know that employers want to be mindful of their employees' health concerns, and employees want to feel comfortable coming back into the workplace. So we felt it was necessary to have a webinar to address these issues, and with us we have David Smith today as our presenter. David Smith is Vice President of Compliance and Risk Management for Even Concepts Company, which is a regional benefits consulting firm that Broome Associates is a part of, and they're headquartered in North Carolina. David is a native of Banner Elk, so not too far from us here, and he's a graduate of North Carolina School of Science and Math, the University of North Carolina at Chapel Hill, and the North Carolina Central University School of Law. His background includes working government as a regulator and policy advisor, in industry with the Cross Blue Shield of North Carolina in sales and marketing, and with both employers and agents as a compliance specialist, also working with employers and insurance agents on federal and state issues that employers face, and consulting for large employer self-funded group health plans. David's a member of the National Association of Health Underwriters, serving in various leadership positions at the local, the state, and the national level for this organization. He speaks throughout the country, focusing on educating employers, agents, brokers, and consultants on the impact of various state and federal laws and the impact these laws have on the purchase and regulation of employer-based health benefit plans. He's been nationally recognized for public speaking. He has also been recognized as one of our industry's top professionals, having been named as the Employee Benefit Advisor of the Year in 2013 and the Health Insurance Professional of the Year in 2018. So David, we certainly thank you for being with us today and appreciate your time. At this point, we will turn the controls over to you and move forward into your presentation.
Thank you, Lori. It's always nice to have another Caldwell County native introduce me. So since I was born in Lenore, I always get to claim that. Appreciate y'all being on the phone call. I think as was previously mentioned, if you have questions, put them in the chat box. Don't be afraid to do that. I will say, like many complex compliance issues, there are no stupid questions. So please don't hesitate to ask them. I will pre-warn you that I don't know the answer to some of them because we haven't been told the answer to some of them. But that being said, I'm gonna kind of walk through this. So, you know, we've kind of been through lots of stages of this coronavirus, COVID-19 situation, how it's impacting the economy. Congress so far has taken what I would call 3.5 steps towards addressing the coronavirus. The first one was really about investing money in finding cures. The second stage was the Families First Coronavirus Relief Act, FFECRA, that was really focused on a handful of things, but the piece that most affected employers was this middle piece about emergency paid leave and emergency FMLA extension, which people have talked about a lot. The third stage, the CARES Act, really is addressing what I would call other elements of the economic situation by putting money in people's hands, the $1,200 payment per adult, $500 per child, the up to $75,000, $150,000 household income that has been going out and people have been receiving. The second major part of that was the unemployment expansion, really to try and help people who have lost their job, that is providing a $600 additional weekly unemployment benefit. That will be on top of whatever the state unemployment benefit would be. We'll talk more in a moment about how that's impacting employers, particularly as it relates to the third part of this, which is the Paycheck Protection Program loans and forgiveness program that is really out there to, for the first time ever, help small employers deal with a significant economic situation. And we'll walk through that in a minute. There's a fourth part of the CARES Act that really was about major impacted industries, airlines, etc., and that piece is separate and apart from what we're doing. And I said 3.5 parts. Lori mentioned the recent replenishing of money into the PPP program, and so that's the 3.5. There are apparently plans out of Congress to do a 4 and a 5, but I don't know where that's going, so I won't begin to speculate about it. So there are really 3 parts of the Paycheck Protection Program: kind of the loan stage, the applying for a loan stage, the use of the loan money stage, and forgiveness. And so I think a lot of employers have been through this "how much can I borrow" stage of this program, even though now a number of businesses that had previously not applied or had been discouraged from applying have kind of gone back out and applied in the last week. The major focus, as we can see from the early stats, is that is on employers that are very small. A lot of self-employed individuals, 2, 3, 4, 5 life groups have now gone and applied for money because they're the people who were the most impacted, the most left out of the first stage of this. But you know, it is important to recognize that if you're a self-employed individual, you have a very small business, you are just as eligible for a PPP loan as any other business with less than 500 employees. So that 500 line is the upper limit. The lower limit is 1. And I've talked to a number of people who have sole proprietorships, small consulting firms, etc. And you know, you'll be eligible for borrowing through this program just like anyone else. I think the biggest issue has been some banks have been hesitant to do things for very small borrowers, even though I think some of that's, again, getting fixed. In the latest round, there was $60 billion that was dedicated to community banks. And so you may also see them being a different focus as this piece goes through. But to determine how much can be borrowed, it's all about monthly payroll cost. So monthly payroll cost means salary, wage, commissions, etc., cash tips, pay for leave, but not for leave through the emergency paid leave or the EFMLA pieces that are getting paid for through a separate tax credit program. The cost of what you spend as an employer on healthcare benefits, what employers contribute to their employees' retirement benefits, any other state or local FICA-like tax that is not federal, and then compensation for sole proprietor independent contractors that figure into this. I will say on that last point, there's been a lot of back and forth about whether or not a business like ours could include 1099s in the calculation of our payroll cost, and I will say that I haven't seen a consistent answer to that. Generally, the way that the program has operated is if that independent contractor can go out and get their own loan, the employer cannot include their compensation in the payroll cost. So then that compensation is reduced by how much any employee makes that exceeds 100,000. So it's not that the employee makes more than 100,000 and you're excluding them completely. It's only being able to count the first 100,000 of their income. The federal taxes piece has been all over the place. I will say that ultimately the loan program is based on gross wages, not on net wages. And so we've seen lenders kind of act differently about that, but the final answer really came down to gross wages. Compensation for employees who live outside of the United States are not included. And then, of course, wages that were paid for through the FFECRA program. You know, the key thing that I've said to people is if you have an employee who makes, for example, $120,000 a year and they work all 12 months, then what you do is you subtract $1,667 from the company's monthly payroll for that employee. Ultimately, the main point is that you can only count up to $8,333.33 of that person's income towards your monthly averages. Once you get to that, what you'll do is you'll add together that for 12 months and multiply by 2.5. Now, there are a couple kind of exceptions to that. So as a general rule, it's the 12 months before you take out the loan. And that's where the average works out. But if you're a seasonal employer that is more busy in that February to June period, then you could use the 12-week period from the prior year as your payroll period. Or if you were not in business before June 30th of last year, then you would use whatever your monthly payroll averages were for January and February of this year. So some kind of variances there. The one group of people who were not excluded were those people who were brave enough to start businesses on or after February 15th of this year. I did see a recent piece of guidance on this that said if you had someone who had bought a business after February 15th, they would still be counted as having been existing as a business prior to February 15th. So that did not change things. So this is my simplistic example about how the loan amount is determined. My example is that there's $100,000 a month in payroll, healthcare costs are $6,000 a month, retirement contributions were $2,000 a month, so the monthly average was $108,000. Obviously very simplistic, but ultimately the loan amount then is $270,000, and that'll be the number I use in a couple of examples as I go through this. So the second part of this is the loan period. And this loan period is very important. It's an 8-week period that during which you can only use the money that was borrowed for certain expenses, payroll cost, payment for the continuation of group health benefits, rent, utilities, and payments of interest on mortgage obligations of the borrower. So you can use it for all of those reasons during that loan period. So probably the biggest problem, I would say, in this where we are today is the loan period and how it works. So one of the things that we started advising our clients about in March and early April was be strategic about when you get your money. Because for some businesses, getting their money too early was going to create a problem where they could affect their FTE averages, and you weren't really ready to open. I talked to a couple of different dental practices, one in Dallas where we have an office, and it was be smart, don't get your money now, because for instance in Texas, they couldn't really open dental practices until this Friday. So if you were going to borrow money, it wouldn't be smart to do it at the beginning of April. Do it towards the middle, towards the end of April, so that your 8-week period will start when you can actually open your practice and make sure your FTE averages are going to be okay. With that, of course, the SBA threw a little bit of a wrench in the deal by saying that the lender had to make their disbursements no later than 10 calendar days from the date of loan approval. So what happened, in my opinion, is that a lot of lenders wanted to disperse the money as quickly as it was approved and they received it, because that impacted whether or not that employer would be able to whether or not that lender was going to be able to get paid their fees for handling the loan. And so we had a little bit of conflict there for a while between them. I think people are a little more strategic, particularly now that the stress of the initial $349 billion ran out. Now that we've got this additional money, I think there's a little less stress on that. So one of the biggest issues that's popped up, I would say, in the last week has been this good faith need question. And I say that that's a concern because one of the issues in the loan process is that the borrower had to certify in good faith that they would need the money because the current, and this quote is literally from the application, current economic uncertainty makes this loan request necessary to support ongoing operations of the applicant. I've probably fielded a half a dozen calls about this question in the last 3 days. and most of it people nervous about how this impacts them. I will point out that this question, there's actually two questions and there's a running FAQ from the SBA, FAQ meaning frequently asked questions, from the Small Business Administration, where they are kind of constantly adding questions to it. There are two questions that are now on the FAQ added this week that really are getting at this point, but really are much more directed at large public companies who went and borrowed money from the PPP program. And we've seen some of these discussed nationally. I think there was a large restaurant chain that borrowed $10 million under the PPP. Ultimately, what the SBA and Treasury are saying is if they are a public company or a private company that had access to capital markets that would have allowed them to not need this money, then they could not in good faith say that they needed the money. And for me, this is going to be a very interesting question to kind of see how it gets played out. The one thing in this most recent piece of guidance that was issued was if you give the money back by May 7th, then we're not going to go after you for having borrowed the money to begin with. And you'll see that acted out upon, in my mind, a lot in the next couple days. Keep in mind, any money that is returned to the loan pool can be reborrowed out. And so I believe that you're going to see some efforts by some large employers to do this. I also think it's important in this process because I think it's going to be an area of great nervousness where a business owner might have borrowed all that they could, but I think ultimately what you do with that money and how you tie it back up into its use is going to be critically important. So let's say you borrowed all that you could, but you only needed $300,000 to get to the time frame. I think repaying that 2.7 that might not have been forgiven is going to resolve some of those issues. But to me, this is one of those areas that's going to be a lot of consternation over the next few days. So the third stage of this is the forgiveness stage, and ultimately the forgiveness stage includes some discussion about how much money was used out of that loan proceeds. So keep in mind, during the loan period, that money can only be used for these purposes. And so you can't use that loan proceeds to go out and buy new equipment or some other investment in your business. A part of the reality of that issue is that people are really encouraged to, you're not having to spend money on payroll, so you should be able to invest that money that you would otherwise have out there. So when determining how much can be forgiven, payroll cost, so including health plan, retirement plan matches, rent obligations, utility payments, and utility payments have generally been kind of broadly defined. I probably have had an interesting question about trash removal and whether or not that counts as a utility payment. And I would tell you that there's still some more guidance to come on that particular question. It also covers mortgage obligations, the interest parts of mortgage obligations. So all of those are reasons why the money can be used. So there are limits on how much of that total sum can be forgiven. Obviously, you can't forgive more than you borrowed, which seems obvious, but it's necessary to say those things every once in a while. Then that forgiveness can also be reduced based off of really two other reasons. One of those is a reduction in the number of employees, and this is where one of the questions that's coming up that we'll come back to in a minute is out there. Also, a reduction related to salaries and wages. So the salaries and wages piece is really ultimately about people who did furloughs, reduction in pay for their employees, And if it exceeded 25%, they would have to get them back above that 25% threshold through this loan period. I think that's the easier of the two to deal with. There's also this very odd language, which we don't know how it's going to operate, which is the loan forgiveness is not reduced by FTE reductions or salary reductions if they restore those people prior to June 30th of this year. And then one of the really last big parts of this is that the amounts that are forgiven under this section will be excluded from gross income. So if you borrowed, the $270,000, and we'll talk about the exact example in a second, then whatever's forgiven is not counted as income to the business or to the owners of the business, and that's a pretty clear piece. That doesn't mean there's not a twist in there, so we'll come back to that. And Nathan, if at some point in time you think I should stop and answer a question or two that's come up, I'll be glad to stop. Otherwise, I'm just going to plow ahead, and then we can just handle them all at the end. So the question about the loan forgiveness based on lower FTE is comparing the FTEs during the loan period against either the average number of FTEs between February 15th and June 30th of last year, or January 1st and February 29th of this year. So I know the obvious question out of that is, how are we calculating FTEs? I'm going to come to that question in a second, because the short answer to that question is I don't know, but we'll talk more about that in a minute. But this is how that reduction piece would work. Let's say that last year, between February 15th and June 30th, you had an average number of FTEs of 58. And then this year, between January 1st and February 29th, you had 54 FTEs. But then when you get to the PPP loan period, you had 51 FTEs. So for that reason, you're going to see what can be forgiven reduced by roughly 5.6%, because again, it's going to be 51, and you can see here, this is really where there's some flexibility, where, between those two previous periods, 58 and 54, 54 is the lower, so 51 divided by 54 is how that reduction in the forgiveness is calculated. So in my real world example, I said we borrowed $270,000, and over on the left, I'm listing all the loan period payroll expenses, or expenses that were paid. So $178,000 in payroll, $12,000 in rent and mortgage, $12,500 in healthcare costs, $4,000 retirement, $8,000 utilities, so for a total of $214,000. Now I'll mention one other twist in here that I forgot to add a slide to, so I apologize. One of the other pieces of guidance that came out was that the employer was going to be, the borrower rather, was going to be required to spend at least 75% on payroll expenses. So payroll being payroll, healthcare cost, and retirement. And that's not, as we understand it, 75% of what was borrowed, but 75% of what was forgiven. And so there's a lot of back and forth about this particular issue, but an area that has, in my mind, a great deal of danger, where you can't say, well, people want to come back to work, so I'm going to pay my rent and utilities just to keep everything alive, and then not be able to have the payroll to go with it, because I believe, based on the guidance, that they will not do forgiveness if you did not have payroll in there. Because again, the key parts of this are using this money for the payroll protection program so that people have pay. I have seen extreme examples of people paying employees to not come to work during this time frame. Or even, to do volunteer work. But ultimately, as we'll talk about in a second, this is creating a little bit of conflict. But going back to my example, So 214,500 was spent out of the loan. So there's $270,000 that was borrowed, but of that 214,500, they're only getting forgiven 94.4% because of the FTE reduction. So that means they're having, of the 270, 202, 583 forgiven, and then the remainder to be paid. So the remainder of the loan left out there is 67,417. So what do you do with what's left over? There's a couple things. First of all, you could just give the money back to the bank, and the bank could take it back, and then the loan's forgiven. The loan is done and closed. The other option is that the employer, the borrower, could use that money for other purposes after the forgiveness decision is made. That's a 1% loan with a 2-year max loan period. And so I can't really figure out for the life of me how that piece is going to work. But what we've said to people is probably a best practice to take that money and put in a separate bank account and track it, and then to be very careful about what you actually use it for. Ultimately, I would say that what to do with what's left over is one of those strategic decisions that are going to have to be entered into very carefully. So of the challenges that are out there, there are quite a few. First of all, we mentioned the fact that the loan pool has been refreshed. There's an extra 320. The president's already signed it. It's done. So I would say the first biggest issue that we're running into is employees not wanting to return to work. And it's become a pretty significant challenge for a lot of employers to get people to come back to work, particularly because their unemployment income, both between what the state is paying them plus the $600 per week federal supplement, is really significantly impacting people wanting to come back to work. And in one of the extreme examples, and I'm sure people have seen this, there was an article last week on CNBC about this woman who owns a spa in Washington State who literally had her employees mad at her for getting a PPP loan. And I would say that is not a rare or extreme example of what's happening out there. I would say it's very, very common right now. And I have talked to a number of people in different parts of the country where their biggest problem is getting their employees to come back to work because they are making more money with unemployment than they would be working. What we saw yesterday was the first step of what we predicted was going to happen a week ago, which is, I believe some states, I've already seen some states, I believe other states will take steps that to basically say to employees who are on unemployment, you have to go back to work, and we're not going to continue to pay you unemployment. And I think that is going to create some conflict in the next few weeks. I think, unfortunately, there's going to be politics involved in this. I was an example of a state that yesterday announced that they would, if the person was unable to return to work because of COVID, then fine. But if they could otherwise go back to work and get paid by their employer, then they would lose their state and federal unemployment benefits. And I think that this is going to be a really, really big issue in terms of how states react to that, because it impacts the forgiveness. One of the biggest conflicts in this process that we've already identified is that the loan period calculation runs through June 30th, and the forgiveness has to be money spent before June 30th, but the unemployment supplement runs through the end of July. So we kind of expect there to be some start on that piece. So the loan period is important. When that money is received, that's when it starts. You don't get to get the money and then say, hey, I want to wait till next week to start my loan period. I think, again, this is an area where there's a lot of issues going to happen and go through. We are telling people to keep track of your expenses, keep your records, have all those pieces. Make sure that you've got, in my mind, the necessary run-in period for your employees to get back to work and everything else. I do think that this is an area where there are a ton of questions that we don't know the answer to, and I believe it's going to be the biggest minefield as we go through this. The other piece that came out yesterday, and I'm required by, of course, law to say that that's a copywritten image of Darth Vader. But we did hear yesterday that the SBA intends to review loan amount requests for forgiveness that exceed $2 million. And they said they're going to review all loans primarily because they want to make sure that the borrowers use the money and they were the ones that were in need of the money. And then, of course, the most ominous thing of all was additional guidance implementing this will be forthcoming. So what I have said to people is, if you've borrowed less than $2 million, you're probably okay. If you have borrowed $2 million or more, there is going to be some additional, in my mind, justification required to talk about why you needed the loan, and it's going to be a part of that forgiveness process. And I think that that's going to be a very, very interesting piece because, again, I think from a broad philosophical perspective, people in executive positions within the administration want this to be a fairly straightforward process. But this is where I think there's going to be some back and forth between people getting the money who needed it versus who did not. And I'm a little intrigued by how this is going to work. So there are really a handful of outstanding questions that we've run into that I will say in advance, we don't know the answer to any of the questions I'm going to talk about yet. And we expect it to be additional guidance that will be issued in the next couple of weeks because we're going to get towards the end of this process, particularly the forgiveness aspect in the coming weeks. So the first of which is, what does costs incurred and payments made mean? And I think that's one of the pieces about the forgiveness and how the loan money was spent that people don't really know. And I think this is the core question of this is, from an accounting perspective, is it cash or accrual? I think that there's an argument to be made for either one of the interpretations, which is I pay somebody for work they performed during the 8-week period, but the last pay period for that period of time occurs after the loan period. Do I get to count that payroll or not? And I don't think we know the answer to that question yet. I think the inference is that if it's money that was spent during the 8 weeks, regardless of when it was incurred, it still counts, but I don't really know. The second question is, now that the loan pool has been replenished, how will 8-week loan periods work if the 8 weeks ends after June 30th? The third question is, so we had business expenses that we pay for with the loan. Are those still deductible expenses? I believe the answer to that question is going to be no. But I think it's going to be, again, a very interesting question from an accounting perspective and tax payment perspective. Do the payroll costs for loan use purposes include or exclude FICA and income tax withholdings? And I would think the answer to that question we have for now, at least by footnote, is that the FICA obligations of the employee and their income tax withholdings are counted as loan proceeds that are permitted expenses. But again, it's in a footnote and not an answer, so I always get a little nervous about that too. How can someone explain how the reduction in the forgiveness amount if the business had to cut employees unrelated to COVID-19? I mean, I think that one ties right back into what I think are the big four questions, which are, how do we calculate FTEs? And I mean, as recently as this morning, I know I had some questions about in preparation for this call that had come in, but I actually got from another one of my agents down in Savannah today about this question. Is FTE calculated based on 40 hours, on 30 hours, on 32 hours? And the absolutely honest answer to that question is we don't know. They haven't said. I think we're thinking the one known FTE calculation process that's out there, and probably the one that most advantages employers, is to use the ACA FTE calculation process, because an employee who works less than 30 hours is going to be counted as a fraction, but 30 plus is being counted as a whole. So, that's kind of one example of something that we don't know the answer to, and that we'll probably get an answer to in the next week. How does a reduction in forgiveness based on salary work? Again, no answer to that question. To me, this next question, what if we rehire and restore employees by June 30th? How will that impact it? To me, the answer to that question is also really driving what I think is a process reality, which is, the employer's 8-week loan period ends the 15th of June or the 20th of June, and they apply for forgiveness with the bank that, lent them the money. When do I think those forgiveness decisions will be made? They got 60 days after the request of a forgiveness by a borrower to make a decision on it, which in my mind means September, maybe. I mean, if you did the 20th of June and you asked for it immediately, then you're talking about the middle to the end of August. But I think there's going to be some delays in that process. And then the last question as to who decides, who really is going to be the person or the entity that decides forgiveness. Right now, it appears to go with the banks or the lenders who, sent out the money. But I think they're all waiting for additional guidance from the SBA about this particular question. So I think that these four questions are really weighing on our minds in terms of how we're going to do that and what the next steps are going to be. So I would say more to come on that. Okay, sorry, I'm going to stop reading questions. I'll also mention one other thing, and then we'll get to questions. There's a provision in the CARES Act that allows employers to defer their part of the Social Security taxes, the Social Security part of FICA, that are due between March 27th and December 31st of this year. And that program will allow the employer to defer their share of it half until the end of 21, the other half till the end of 22. Originally, the way that was written and the way the statute says it is that if the employer applies for a PPP loan, they can't do this. Additional guidance came out that basically said that the employer can defer their portion of the Social Security taxes until they receive a forgiveness decision from the lender. And so again, going back to that extended process, I think that plays out into a very interesting place. What we said to people is you got to be smart and careful about this. Payroll companies are probably going to want to have some certification from employers that they've not been told they've got forgiveness yet. So be aware of that, because it's going to be a very interesting thing to get carried out. So that's a lot of talking from me. I did say 45 minutes, so I was pretty close. So with that, I'll start taking questions.
David, hey, this is Nathan here with Catawba County Economic Development, and I will say we've done now, this was our 5th webinar, and you did an awesome job of covering really terribly difficult stuff to understand, and I know we've got a lot of questions, and thankfully you answered a lot of those, but there's still some I noticed that are fairly specific, and I wanted just to go through those with you. And hopefully I've got enough information that you can answer these from, or people can add to it if they need. But one person wrote back that they have someone that they reimburse them for business-related travel, and I didn't see that in any of your slides, but would reimbursable business travel be considered an allowable expense, a forgivable expense?
So there is an interesting question that's popped up about that. I think that the general rule, as I understand it, is that business travel is going to be considered a deductible expense otherwise. And I don't know that it's very clearly outlined as a payroll cost, because it's not falling, truly when you have somebody, I travel for work all the time, but whenever that travel is paid by me and then reimbursed, that reimbursement is considered a business expense to the employer, but not a payroll cost. And so I think it's going to ultimately come down to that. Kind of the alternative view of that is you have an employee who some of their time is spent on business development, and so that maybe there's business development expenses for that person that are related to payroll, then I would say the payroll is. But I would say generally, based on what I have read, that business reimbursement is not going to be counted as payroll costs because it's not treated as payroll cost under the business expense deduction. But that's, again, what I would say is my understanding of it. I always have to preface everything I say with I'm not an accountant and I don't play one on television or on any other forum, so I'm simply reacting off of what I've read and seen.
Got a question related to when you're calculating that gross payroll, you use after those pre-tax deductions for, say, supplemental insurance?
So again, I think it's going to depend on how the supplemental. So ultimately, keep in mind that when you have, let's just say an employee gets paid $1,000 a week, that's their gross pay. But out of that $1,000, they pay for their share of health insurance premiums, and they pay for their share of dental premiums. Maybe they've got some supplemental life insurance in there. A lot of that is going to be almost irrelevant in that calculation, because ultimately, from the employer perspective, they paid the employee $1,000. And so the $1,000 is the payroll expense that would get counted towards the loan proceeds.
David, one other question. What if the deposit or the collection of the funds from the bank, the PPP funds, into the employer's account starts that 56-day time period, but it doesn't align with the payroll period? How is that going to be handled on the back end, or what's the best strategy to approach that?
I would say that is another one of those. I'll step back for a second and say something from a philosophical perspective. A lot of laws are passed at what I would call the 30,000-foot view, and therefore they don't really think about the reality of how things work. The ideal extension to that is that mainly regulators are expected to provide additional guidance that helps close the gap on some of that. I think this is an area where there's a problem where, so again, going back to that first of those unanswered questions, that payroll period doesn't line up. But let's say you got your money on Wednesday and you paid your employees on Friday, right? So, but you're paying your employees Fridays for a pay period that began or that ended the prior Sunday. So are we counting that payroll towards it or not? And again, I think that's the accrued versus cash question, because it's on the back end. I mean, we've had a couple employers come to us and say, hey, we want to change our payroll periods from biweekly to weekly during this loan period so that we don't run into this problem. And I think this is one of those practical impacts of the lack of answers to questions that my gut tells me that the intent is for people to not have to completely change their process during this, but I think the failure to provide timely answers is going to cause people to be extraordinarily cautious, wisely, in this repayment process. And I think it's going to create some conflict.
Thanks, David. One other question that's come up too is, can employers add bonus pay or hero pay for those employees who have come in to work, like maybe healthcare workers or daycare workers, folks like that had no choice but to work during this time period? Can that be included in that payroll and forgiveness?
It definitely can. Let me say this. I've not seen anything that says you can't pay your employees more. Again, you want to be careful, and obviously there aren't going to be a lot of these situations where that pay may cause that person to be over $100,000. Again, if you pay an employee more than $100,000 annually, so really ultimately in my mind, that's, you know, $83.33 a month. Sorry, I always feel the need to pull out my calculator when I do this.
We've had a couple fairly similar questions that,
yeah.
You know,
I'd say anytime that you pay an employee more than $19.23.07 per week, then you probably are not going to be able to count the amounts above that. Sorry, Nathan, go ahead.
Oh, you're good. We've had a couple cases. This was like, you know, the Oklahoma land rush, and everybody tried to get in their applications for PPP as quickly as possible. You've got potentially situations where people have been approved, but by nature of their business, they are restricted. Say a restaurant, good case. You know, you're very likely don't have as many employees right now doing curbside service as you would in a normal situation. So they've received funds, but by restriction, they're not allowed to have all those employees back. Any guidance for folks in that situation?
I mean, I think I've had a handful of conversations with restaurant owners. I think that for the most part, this has been, like you said, the Oklahoma land rush, where people rushed to get the money. And I would say that the banks were probably encouraging them to get the money in their bank accounts as quickly as possible. But the practical reality is that there's going to be, in my mind, some conflict between the FTE calculation over the loan period and the practical business realities. And I go back to my dental practice example, where you know, if you got a loan the 10th of April, and that's when it was funded, but you really can't open your dental practice till the 8th of May, then you're going to go 4 weeks of your loan period without any employees or very few employees, unless you're paying them to not come to work. And so I just think there's going to be this conflict in that way. And then on the other side of it, let's say you decide as an employer, hey, I realize that I don't have work for them, but I'm going to pay them so that I'm using this money for the purpose for which it was intended. Then you impact that individual employee's ability to get unemployment benefits, which could be more than what they're getting paid by you. I mean, I do think that there's a fundamental issue that I've run into, in that people, and particularly I'd say anybody in this process, mistakenly believes that this is a business loan program, and it's not. This is a government funded approach to try and keep money in people's pockets, and the mechanism by which they are using it is through a loan program, and it's language that I don't think translates down very well from the government to banks to borrowers. And so if you asked, you know, 535 members of Congress what they thought this program was going to look like, you'd probably get about 15,000 different answers. But I would say on one side of the aisle, you would say this is going to allow businesses to continue to be viable after this after the economic impact of this. And I think on the other side, you would have people say this was a way to get people to still have their income dependent on their employer and not on the government. And so I don't know that there's an easy answer, because there's a conflict between this program and the unemployment program. That's probably a little high-minded economic theory, but that's really, I think, where it's coming down to.
David, it's Lori again. I do agree with you that I think the intent of the legislation was to hit the pause button and send everybody home, keep them paid, and then bring them back. But unfortunately, you can't take a cookie-cutter approach to various different industries. But I do want to go back and ask you to reiterate one thing, and that is, if an employer offers an employee a rehire opportunity and wants to bring that employee back to work, that employee has taken unemployment and that employee refuses to come back to work, then really that employee is terminated, and they really don't have access to unemployment anymore, do they? Because the employer would report them as not being an eligible employee or a terminated employee. So the employee is really short-sighted if they choose not to come back to work. Am I correct? Is that?
Well, I mean, I think this is a hard thing to assign intent to people's personal business decisions. I mean, at one level, we've got a situation where people are making whatever unemployment they would have plus 600, which in some situations per week, which in some situations more money than people were making to begin with, right? I don't know that it's as simple as, I offered to bring Andrew back to work, and Andrew's like, no, I don't want to come back to work. I'm comfortable with my unemployment, but I'll come back to work in August when this is over. Do I think that employer is required to bring that employee back in August? No. Do I think that employer can go out and hire somebody else who could do the job that Andrew was doing? Yes. And do I think that person who's not the same person who was working on the 15th of February would get counted as an FTE? Yes. I think ultimately this is where the politics of how unemployment is continued or not is going to impact the small employer the most significantly, because I don't believe there's a black and white answer to that question. I don't believe that employee who refused to come back to work is necessarily going to be denied unemployment benefits. I think it is going to be very dependent on the political decisions made in each state. And I think what you're already seeing in places like Georgia and Tennessee, decisions by their leadership to say, if people can go back to work, we're not going to pay them unemployment. And I think that's just one of the things that's going to happen, and that we're going to see more and more pressure in both directions about how government reacts to that, particularly with the unemployment program. The easy solution to some of this is that return to work thing gets extended to July 31st, and then there's a lineup between the unemployment benefit extent or the supplemental income and eligibility. But I don't know that it's that easy. Yeah, and Andrew is happy to work. I'm not saying Andrew Kaiser. I'm just saying.
Well, David,
I can't win, just for the record.
No, you can't. It's impossible. Kind of looking through the questions, I think you hit snippets of all of them. What I'll say is, first, want to thank you. You're right on an hour, man. We're good for time. You did a great job and thorough job of really digging through some very tough things. So thank you for your time this morning. Thank you for Lori, for Broom Associates, and even Concept for really being kind of the brain power behind a lot of this stuff today, because we can't answer it, I know, from either the chamber or EDC, and we don't know the specifics like these folks do. So thank you all very much. I did put an economic impact survey there. It's a terribly long URL. I apologize for that. Please take the 5 or 6 minutes to answer those questions. Really, we're just trying to gauge how to best help and really trying to understand where people are feeling the most pain. And also for things like this, if we notice there's a continuing trend that people are really feeling pain in a particular area, we need to bring in some expertise and have, think forums like this where you can ask questions and really dive into some subject matters. I did lastly want to say that I'm going to keep the chat feature up. We'll keep this going for a couple minutes. If you have a question that maybe did not get covered, please type it in there. We'll circle back, try to get answers to those questions, and then email those out later. Other than that, we very much appreciate everyone's time this morning. Have a wonderful day. Stay safe. And again, if you've got questions, please put those in there. And I'm sure we'll be having more of these opportunities come in the future, so please keep an eye out for those. Thanks again.
Thank you.
Thank you.